Hi and welcome. I'm Steve Johnson, Chief Investment Officer at Forager Funds, and thank you for joining us. This is our annual virtual roadshow presentation where we run through the results of the past year, talk about what we're looking forward to over the year ahead. Before we kick things off, a reminder that today's presentation is general information only. We cannot and do not take into account your personal circumstances, and you should seek professional advice where necessary. Look, it's been a wonderful year for the Forager business and for you, our clients, and it's been particularly pleasing for me. The contributions across the whole team here at Forager have been very significant. We've had both funds performing really well. And I think all of that is a reflection of the hard work that we've put into process and procedure over the past decade. And you're going to hear plenty from the portfolio managers of both portfolios later in this presentation. But before we get there, I just wanted to go back over some of those things that I think are the important building blocks of the success that we have seen over the past 5 years for both funds. First up, we've got what we think are some unique attributes here at Forager that allow us to do what we do. And the most important of those is you. We have genuinely long-term customers. We have a quite diverse customer base as well. And we have a very good relationship with those clients, and that lets us invest for the long term. You see a lot of businesses out there, a lot of investors out there that talk long term, that even would like to be investing long term. But when your clients are monitoring your performance on a monthly and quarterly basis, it makes that very difficult. So that asset is very important to us, and we combine that with a very strong awareness of the capacity constraints that we face as a business. As you go through today's presentation, you're going to hear about some really interesting small stock stories. They are an important part of our process. There is more inefficiency at that end of the market, and it's important that our funds stay small enough to execute on what are the best opportunities out there in the market. And then thirdly, and again, really importantly, contrarian behaviors. You've seen a change in this, I would say, over the past 10 years. Selectively contrarian is the word that we like to use. There's a time and a place for being contrarian and for it being a generator of huge amounts of returns. And there is a time and a place when markets are expensive and optimism is high, where sometimes the contrarian ideas are not necessarily worth pursuing. And we've put a lot of work in over the past decade into keeping that contrarian bent that we have, but applying it at the most appropriate times. We've made some clarifications to the product over the past couple of months, where we have always been focused on smaller companies, but you've seen some changes to the PDSs that clarify that, particularly for new investors. I'll touch a little bit more on that at the end of the presentation when I come back to wrap things up. I think for our long-term investors, they've always understood that it is a focus on smaller companies because that's where we think the inefficiencies are, but we have made some changes there to the products to make that clearer to everyone. You should expect Forager's portfolios to change a lot. We want to go where the opportunities are. You'll hear today in our international fund how big Japan has become as a part of that portfolio. It's large today. We think that's a really good 10-year runway for returns there. There may come a time in that international fund portfolio where Japan is a very, very small weighting like it was 5 years ago. So the portfolios are going to change quite significantly as the opportunities that are out there change. And our objective with all of that is to deliver you long-term outperformance of markets. And it's been a great couple of years on that front. What sort of stocks should you expect us to be finding? Well, there's some pretty straightforward things. We are buying businesses, and we're buying businesses that we think are going to give us long-term cash flow returns that are in excess of our minimum required rates. Where do they typically come from? The market doesn't give you those sorts of opportunities in plain sight. So you will see us looking in unloved and or underappreciated parts of the market. And we also want to make sure that we stay within our circles of competence. And that's a term that's thrown around in the value investing world a lot. It simply means businesses that we can value. We have a track record. We have an ability to forecast its profitability into the future. That's not going to be the same for every single company, but we want to be able to build a mental and actual financial model for a company that tells us what sorts of returns that we think it can generate. And we want all of those things to come together in the opportunities that we're finding. So, yes, it's got the basis for a long-term return. Yes, it's a business that's in our circle of competence. Yes, it is unloved and or underappreciated. They are the types of things that you're seeing going into Forager's portfolios. And then I talked about this last year. It's something I think we've executed really well on over the past 12 months, is bringing a heightened awareness of risk and the relationship between risk and return across our portfolios. It's true at an individual stock level. It's also true at a portfolio level. I think as you'll see as we go through today's presentation, some of these things in practice: resilience, liquidity, and diversity across the portfolios. That's easier in the international fund where we have the whole world to put a portfolio together, but it is equally important, and maybe even more so, to be thinking about these issues in our Australian fund where we have a smaller universe, but the correlations of risk across those different opportunities we give a lot of thought to, and how the different parts of the portfolio can interact. We have not been dramatically tested over the past 12 months, but that March, April sell down in markets, I think, was an interesting little insight into the work that we've done on this part of our portfolio management over the past decade. Particularly on the international fund side of things, we had a really, really good April. A, being down less than the market was down, B, being able to deploy some cash into that, and then C, seeing some of those opportunities recover really quickly. So nice to see some of this stuff unfolding in practice. I said to a client yesterday, I watch a lot of cricket and you see a lot of people talking about how well they're hitting the ball in the nets. It doesn't really count for anything until you're scoring runs out in the middle. And I think what you've seen over the past 12 months is these principles that we have been talking about for a number of years really starting to turn up in the results that you're seeing in the funds. A couple of examples of that. I put this bar at the top here in our presentation last year, talking about us adjusting the required return that we need from a stock depending on how much risk and liquidity that stock has. And we've seen some great returns over the past year. Stocks like Tesco in the international fund, Dalrymple Bay Infrastructure in the Australian fund, that were at the low end of this spectrum, but were very low risk, high liquidity investments. We bought them on 12 and 13% returns, and we've sold them when the market had re-rated them to a level of 8 or so. And on the right-hand side, we've seen some huge returns from the higher risk opportunities where we demanded 20% plus returns, and we got more than that because that return compressed in a hurry. And it's also been, you'll see as we go through the presentation, that riskier end of the spectrum has been where the losses in both portfolios have been, and mitigating the impact of those losses on both portfolios has been extremely important. We have a slide here. This is probably the fastest that you're ever going to see a stock idea in a Forager portfolio play out of this magnitude. We've made 10 times our money off a stock in the international fund, Nutex Health, in less than a year. What's really interesting though, and I think what we've executed well on, is getting the portfolio weighting right at the various points along that journey. The risk of this situation and the liquidity of the stock changed dramatically as it released results to the market over the course of 2 and 3 quarters. And you can see we started here with a less than 1% portfolio weighting because of the risk of the situation. We actually added quite aggressively to that stock, even though the share price had doubled. As value investors, that has been a hard thing to wrap my head around psychologically and emotionally, but in these riskier situations, it's been incredibly important. It got as high as 5% weighting in the portfolio as the cash started to come in and as the balance sheet fixed itself, and as we got very, very confident in the profitability of this business. And then you can see on the end of the chart, as the share price ran up very aggressively, we've cut that weighting quite significantly, and it's now 2.5% of the portfolio. So a stock that actually added 7% to the portfolio over the year is only 2.5% of it today. And I think you've really seen that portfolio management and that bar that's at the top of this slide in process over the course of the past 12 months. And that was true across both portfolios as well. We've got Catapult up here as another example from the Australian fund, a stock that we added to quite aggressively over the past 12 months as thesis confirming results started to come in. It was a stock where management had laid out a plan for that business to be profitable and cash flow positive, but it had a pretty long history of not delivering on its promises. So it wasn't until we started to see the tangible evidence come in here that we got the confidence to really up the portfolio weighting. That process unfolded over a space of 2 years. Our maximum portfolio weighting increased quite dramatically over that time, and it got up to 10% of our Australian fund. That stock is now covered by a couple of bulge bracket research companies or brokers. It is pretty widely owned in the small cap universe now. It's actually gone into the ASX 300. If it keeps on its trajectory, it'll be in the ASX 200 soon. So it's not the differentiated idea that it was even 12 months ago. And post 30 June here, you've seen us cut the weighting of that stock quite significantly. And that discipline around selling successful investments is as important as the adding to things on the way up. And it puts us in a really good place, I think, for executing on the opportunities that we see in front of us today, rather than it just being the stocks that have worked over the past 12 months that are the largest weightings in the portfolios. Hopefully you've read your annual performance report by now and seen the great returns that we've been posting. It was good across both funds. I've split it into half years. It was a fantastic first half for the Australian fund and a good second half, and that was flipped around for the international fund. We had some really good gains with a lot of that Nutex return coming in the second half of the financial year. You can see here as well 5 and 10-year numbers, which is where we're really focused back to where we think they should be, into double digits. And it's been a really good period here of more consistent returns, which is what we want to see from the fund. Both funds have had 3 good ones in a row now. For the international fund, it's actually 5 out of the past 6 have been better than market and meaningfully so. And in the Aussie fund, you can see a really good 3 years there, following on from the up and down of 21 and 22, but showing up in some really nice longer term returns there. And I said last year I thought we were really, really well placed for a decade ahead, and I'm more confident of that today than I was 12 months ago. The opportunity set that is in front of us is as healthy as it was. I wrote in my annual letter to you as investors, this whole dynamic around passive funds, around super funds needing to hug the index because of the government imposed reporting requirements that they have. It is just creating a constant pipeline here of opportunities that are coming out of indexes, falling out of favor. That's always been our sweet spot, buying those businesses, but the magnitude of the moves is double what it was even 5 or 6 years ago. And we're seeing plenty of opportunities out there today to redeploy some of our winners into some really attractive opportunities that we think can continue to deliver results. It's very obviously not going to be 30% year in, year out. We are going to have periods here over the next decade where we underperform the market. That is almost a certainty with our style of investing, but the ingredients are in place here for a really good period ahead for us. I'm extremely proud of what the team's achieved over the past 12 months. There was a little line in that report about how little I had contributed to the returns of the funds, and that's me doing my job well. We have worked hard on a process here and hard on attracting some really talented people and keeping them in our business, and you can see the results of that over the past year. And with that, I'll bring Alex in and we will discuss what's been going on with the Australian fund.
Thanks, Steve, and hello, everybody. I'm going to give you a bit of a rundown of the Australian fund, what's been going on the last 12 months, what we're thinking about for the next 12 months as well. Now, it's important to note this fund now has a 15-year-odd track record, which is quite long. This is a valuation-driven approach that we apply to unloved and underappreciated small and micro-cap stocks, while still managing this portfolio for resilience, for diversity, and for liquidity. We thank our 1,500 odd unit holders for your support over the last couple of years and the 15 years of the existence of the fund. There's one other thing just to note on this slide. The small odds index is now our objective to beat that index. That's replaced the all odds index. It's more representative of the universe that we play in and allows you to better compare us to other funds in the same space.
Now, Alex, we've got both of the benchmarks here on this next performance slide, but whichever way you cut it, it was a fantastic year in 2025.
That's right, Steve. Really pleasing year of performance, bested the all odds and the small odds by more than 15 percentage points. That's lifted the 3 and 5 year numbers to about 20% annualized for the fund itself. And pleasingly, despite that smaller cap universe having underperformed the larger stocks, we've outperformed since inception those larger stocks by more than 2% and more than doubled the performance of the small stocks since inception.
Looking at the contribution slide here, we've talked all about Catapult a lot over the past 12 months, and we've got a couple of slides coming up about it today as well. But I was particularly happy to see the breadth of contribution here across the portfolio.
That's right. And there are 12 positive contributors here, providing more than a 1% return to the fund. 3 negatives detracting more than 1% as well. Some of them we'll touch on a little bit later. The top two contributors, software businesses, Catapult and Bravura, it's really continued the success we've had in this software space in the likes of Gentrack in some prior years. The next two, quite boring businesses, really, AMA Group and Motorcycle Holdings, some operational improvements and some sentiment improvements combined for some pretty impressive contribution to the fund. We've had good contribution from new and old investments here, offset by a few negatives from especially two tourism operators. Just moving on to Catapult, and by far the biggest contributor this financial year, 12% of the returns that you saw. We've talked about Catapult a lot. It's been the biggest investment in the portfolio for the last 12 odd months. And the business here has really executed our thesis with precision. It's continued to be globally dominant in its wearables business, accelerated growth from new video, which has been great to see. This has resulted in really strong growth in revenue, and that is actually really high quality, sticky revenue. The business has seen operational leverage kick in, so 65% odd of the incremental revenue has fallen through to management's preferred measure of profitability, and the business is now generating some good free cash flow. Now, we're pleased that the business has achieved the milestones that we were looking for. As it achieved those milestones, we were increasing our weighting as we saw more clearly where the business was going. And that's resulted in a bigger contribution to portfolio returns than we would have otherwise had. Now, we're also quite valuation conscious. Now that the business has become the domain of larger investment banks and bigger fund managers and is just generally better known, we have taken the opportunity and cut back the weighting from about 8% to about 4%.
It was a great year from Catapult, Alex, and it was also in the right part of the market. Tech and growth stocks did well over the past 12 months. And that's why I think it's pleasing that there's other parts of our portfolio here that are not in that darling sector that have also contributed quite significantly to returns.
Well, that's right, Steve. And we had a couple of quite large contributors here. Bravura is, as you mentioned, a financial services software provider. It's high quality. It had recurring software revenue all the way along, but just leveraged with far too much cost. And management really put up an amazing display of cost discipline in this business, which has really led to that very impressive performance during the year. But two businesses that you could have described at the beginning of the year as quite boring, AMA Group, which is the panel beater, now finally fixed the balance sheet with a capital raise. We participated in that capital raise. Subsequent to that, we've seen operational improvements and their insurance customers more willing to pay for the repairs that AMA is performing there. And Motorcycle Holdings, which is all things motorcycle, retailer, wholesaler of accessories and motorcycles. Now, it saw quite strong performance from its CF Moto brand, which is a brand that they distribute in Australia. And then towards the end of the year, did a very savvy deal to buy some dealerships from a competitor where that competitor was in administration.
And it wasn't all good news for the year, Alex. It almost never is, but a couple of stocks that contributed on the negative side of the ledger over 2025.
ReadyTech being one. This is an enterprise software business as well. Now, we had disappointing growth out of ReadyTech, specifically dragged down by local government revenue. It remains a growing recurring revenue business, and it continues to improve its cash profit margins, not to the extent that us or investors were thinking 12 months ago, perhaps. It started as particularly a large investment, remains quite significant, which is why that 25% fall in share price cost what it did to the portfolio. Camplify started as a smaller weighting, but share price wise saw a much larger fall. Now the business there is not what we thought it was. It is not as high quality. We saw growth in Australia slow markedly. We saw some poor performance in the German acquisition that they did, and was even when it was done, it was an overvalued acquisition. So we made mistakes here, the assessment of the business itself, but also the subsequent trading, where we added to a position at the wrong times. Moving on a little bit to the portfolio snapshot here. Really want to emphasize the sweet spot for this fund is that $100 million to $1 billion market cap range. There are plenty of unloved and underappreciated businesses in that market cap spectrum in Australia, but it still allows us that resilience, the diversity, and the liquidity that we're looking for from the portfolio as a whole. You can see on the right-hand side here, large financials and technology exposures. We'll get into some of that shortly. Together, that makes up about half of the portfolio at the moment. That positioning, as I mentioned, you can see at the top there, 19% in software. ReadyTech and Catapult are two of those. Of course, mentioning that we've brought Catapult down somewhat after the end of the financial year. Bravura is also in that bucket. For financials, we can split it quite neatly between payments and the financials excluding payments. On the payment side of a business, Tyro, a provider of payment terminals, and Cuscal, a back-end provider of terminals, of infrastructure for payments. They themselves cater to different spaces in the payments ecosystem in Australia. And EML, which is a global business more on cards, and rechargeable, reloadable, and otherwise cards. That business is a little bit different with respect to what it's trying to do and the success factors that it will need to be a good investment for us over 2026. On outside of payments in financials, Praemium has been a large position and remains so. That's dependent on fund flows into the platform. And the NZX, which we'll touch on shortly, will be dependent on the level of activity of its NZ market. That is the level of trading and capital raises, as well as fund flows into its funds management business. Tourism and the leisure continues to be an investment, reasonably large investment in the fund. Experience Co. and the corporate travel business there, that's a corporate travel management company. And a few smaller investments there, some beaten up micro caps, which amount to about 15% of the portfolio here. There are two good examples for this. People In, which is a labor provider, and hipages, which is a tradie marketplace. Those and other companies in that beaten up micro cap space can be bigger positions for the fund over time as well.
I'll just run through a quick snapshot of the portfolio. Important for people to note that we've put the 4th of July at the top here. So this is a snapshot at the end of the first week of the new financial year. As Alex touched on earlier, we've cut the weighting of Catapult quite significantly once the previous tax year was behind us. And you can see it's still an important investment and on this list, but one that's a much smaller weighting than it was for most of last financial year. You can see a lot of 4 to 5% weightings here. There's stocks in this list that we think can be much larger weightings over time, but we're still in that thesis confirming phase of those investments. And we'll talk about a few of them in detail, starting with NZX. Alex.
That's right. So this is the operator of the stock exchange in New Zealand. That business is not the only business that they have, though, even though it has become synonymous with it. It has a business in ETF and low-cost funds management there. That's been a business that's grown structurally over long periods of time, organically and via acquisition, which has been great to see. And also a wealth technology business, which is akin to a hub and Netwealth in Australia, though a little bit more enterprise software skewed. We're looking for the stock exchange traded volume and capital raisings to come up. It's more a cyclical issue over time. That incremental revenue will come through at quite high incremental margins, and the growth in the other two segments to continue as it had done over the last little while. Again, all those factors considered, at 11% free cash flow yield to enterprise value over the next couple of years, a very interesting business.
And Tyro's been in the news lately, and a big RBA paper into the payment system out just last week as we're recording this that may have an impact on this business.
Well, the impact is likely to be positive, we think, Steve. And Tyro it's really a business that's got quite a key part in that payments ecosystem. Yes, the regulatory regime is evolving for the business, but actually there's others that are going to be hit by that quite significantly, and Tyro will be there to take those customers on from those that are unable to operate or not as attractive with surcharges banned, which is the current proposal. There are there's over 70,000 merchants here. It's a reasonably sticky solution with merchants, and the incremental gross profit dollars here are going to be coming through to free cash flow at quite high rates as well. So another one to look for in FY26.
Yeah, it's one where I'm actually looking forward to the new regulations coming into place because I'm pretty confident that that business is not going to be as badly affected as the share price would suggest. And we're going to need some results to prove that to people. Another stock with payments in its name, EML Payments.
That's right. Now, this business has been mired in a lot of controversy over time, acquisitions, regulatory issues, a lot of things that have needed to be cleaned up here by prior management teams, but we think that has actually occurred now. This is a global provider of quite niche card payments solutions for governments especially in the UK, for salary packaging in Australia, and for gift cards in North America and in Europe. What we've left with here is actually quite high quality recurring revenue alongside interest revenue from the balances that EML holds. Now, after the cleanup, the business needs to get back to growing its customer revenue, and the new management team is well incentivized and well credentialed to push on that side of things while keeping the cost base reasonably consistent. They've got some targets out there that are quite lofty into 2028, but even if they don't meet those targets, we will still get quite an attractive return from this business given the growth that we are looking for here.
Now, Alex, we'll wrap up your bit of the presentation here, but I'm going to get ahead of the Q&A because I know this question is coming. It's been a very good year on the back of a very good year last year, and we're already getting the question last year about where to from here, given the returns have been so strong. What's your view on the outlook for the fund?
Well, Steve, as you say, we've been asked about it a couple of times now. We've had 3 good years. People have seen solid market returns, but I'll make 3 points here. The first one is that we have seen, as you can see on that slide, the All Ords dramatically outperform the Small Ordinaries Index. And over the last 5 years, that's totaled more than 30-odd%. So when you look at the rises in the likes of CBA, that's not really the space that we've been playing in. The performance in our space has been a lot more muted. Smaller industrials, where we have sort of spent more of our time and where we find more of our opportunities, that was up only about 9% last year, which is not dramatically more than you would expect year to year. And our gauge of opportunities in the Australian market is actually not that dramatically different from where it was 12 and 24 months ago. And that's because despite some businesses doing quite well, there are plenty of others that have disappointed investors that have come off very lofty earnings multiples that are being removed from indices. that are not participating in any of the optimism that we've seen. And that really gives us a good, exciting opportunity to deploy capital that we've recycled from some of our winners into those investments.
Well, looking forward to seeing what all of that rock turning looks like over the next 12 months and the results that that can deliver for all of us. We will move on to the International Shares Fund now, and I'm going to bring in Harvey and Gareth here. You're probably quite familiar with these two. They've been portfolio managers of this fund for the past 3 years here and have built up a really good team of analysts around them and also been executing on some sensational investment ideas and great investor returns. I'll hand over to you, gentlemen.
Thanks, Steve, and hi, everyone. Thanks for your time and attention today. We're going to talk a bit about the year that was and the year that's ahead in a moment, but first I wanted to take a moment to talk about team and team structure. Harvey and I are both very happy with the team we have in place today. We're really looking forward to Chloe coming back from maternity leave around Christmas, but we have a replacement for her at the moment in Mark, and the team's hardly missed a beat this year. Our new idea process is working quicker than ever before, more accurately. We're very happy with how that's going and with the team dynamic. We don't wish to add to resources here. We have a sufficient redundancy amongst the various members. We think this is an optimal team size and structure. We have plenty of analytical firepower, but yet we're tight and close and nimble enough to move quickly on ideas and make decisions. And that's a real edge in that smaller cap universe where our advantages historically have lied. This is a global fund focused on smaller and mid-cap opportunities, mostly in developed markets around the world. It's concentrated. We own 20 to 40 individual stock positions. We want the right idea to really be able to move the needle on investment performance without taking excessive risk on any one idea. Nutex this year is an idea of that done very well, and something we hope to replicate over the years. We then spend a lot of time thinking about how these individual pieces fit together to put a portfolio together that is not too risky. We've made some changes to our PDS this year. We've changed the benchmark to a small and mid-cap index, and we've capped the percentage of the portfolio that can be invested in larger investments. Look, there's very little functional change from this. It's more about giving investors clarity about who we are and what we do. Small and mid-cap stocks have always been the focus of this portfolio and where we've had our greatest successes historically.
And moving on to performance, we're not going to spend too much time on this slide. You can all get the numbers from our website should you choose. But I think the core message here is that over the last 6 years, since the core team here has been together, we've outperformed both our current benchmark and our previous benchmark by a pretty decent amount. The last 3 years and 1 year rolling has been over 5%. So we feel pretty good about that. And we also feel positive that we've outperformed the large cap benchmark as well, particularly given the headwinds that this mid cap index has faced over the past few years. We'll discuss the background and some of the breakdown of this performance on the following slides.
Nutex has obviously been a massive contributor for the fund over 2025. We'll discuss that a bit more in a moment. But there have been lots of other meaningful contributors here. Even the basket of stocks that were too small to move the needle individually have contributed more than almost 7 percentage points to the return over the year. We had a few losers in the commodities and consumer discretionary space. We're going to talk about consumer discretionary a bit more later. We also lost some money on an idiosyncratic smaller cap called So Good. We made money out of it in 2024. We gave it back and then a little bit more in 2025. Look, that's sort of the nature of the smaller cap end of the market. It's noisier. Our strike rate in the smallest businesses is lower than it is in the medium-sized businesses. But we've had numerous really important winners in that small cap end over the years. Celsius, Norbit, Zeta and Blanco, and now Nutex. We can't promise a consistent flow of those ideas, but they do come along regularly and we have a track record of pouncing on them. What we've worked really hard on over the last few years is to try to make more from the winners and lose less on the losers. And we're really proud of the progress we've made there over this year. And we think, Nutex and So Good, the differing amounts we've made out of or lost in each is an example of that in action. The flip side of the portfolio here is the quality compounder businesses that tend to be more medium-sized businesses. They have provided more consistent returns over the years. 2025 was no exception there, and they've been an important contributor, and you should expect to see more of the same in future.
So here's a slide that talks about the breadth of contribution by thematic and their current respective weightings. This is not exhaustive, of course. There are obviously other themes invested in the portfolio is invested in. But on the bottom left-hand chart, you can see that high-quality compounders is a decent chunk of the returns over the past 12 months. We expect that it always will be, buying the good quality businesses at the right point in time when they've fallen out of favor or whatnot is a core part of this portfolio, and we expect it to remain so. Idiosyncratic small caps is the other bucket that has contributed a decent and fair amount over the past year. You, again, expect to see that in the future. We've had that bucket deliver strong results over the past 5-6 years, various years, different stocks. But that is always a pond that we fish in. And, sometimes you can lose money in it. It is, by definition, more volatile and more risky at that end of the spectrum. But also the big wins tend to happen there as well. European yielders is not a huge basket by weighting, but it is a very important part of our portfolio, which we still have exposure to. This will include things such as Tesco and the European banks that performed actually very well during this March-April meltdown, the tariff tantrum, as they call it. So it was a great little offset to some of the other things in the portfolio that did move down alongside with the broader markets and the US in particular. And you'll notice that we have a Japan digitization bucket here. It's currently 16% of the portfolio. It was an already solid contributor over the past 12 months, but we remain very positive on this opportunity going forward. We have a slide later on that discusses that in a bit more detail, so I'll leave it until then to go and into depth there. So Gareth mentioned Nutex Health. This is a stock that we found over a year ago. It was a company that had gone down 98%, real microcap, too small for most funds to be invested in, but it did trade in the US. There was enough liquidity to build a position. We saw that the underlying business momentum was actually turning, and that a lot of the metrics that you see on the surface, if you go through Bloomberg or Capital IQ or FactSet, were a bit misleading. They had a significant amount of net debt on paper, but actually these were operating leases. And the underlying momentum of the business was turning for various reasons. Now, many of you that have read our reports will be familiar with Nutex Health, but for those that aren't, they run a bunch of micro hospitals in the US, or micro emergency rooms, rather. All private insurance focused, and it's a really interesting business. We visited a few of the facilities, and we got even more positive on the business having done that. State-of-the-art technology, equipment, and really friendly staff. So what we saw here is a bounce in margins after a long period of declines that related to regulatory changes in the US. We thought this was a great opportunity to start building a position here. I believe Steve touched upon how we scaled in and doubled down as we got evidence that our thesis was unfolding in the way we wanted. So biggest contributor over the past year, it remains a decent sized position, roughly around 2.5% weighting today. So we've taken a bunch of money off the table as the share price has gone up almost tenfold, but it still trades at a very attractive valuation relative to the broader markets out there, and the US in particular. It's a great case study on our investment process and proactive management. You size up winners as the market starts to understand what's going on behind the scenes, digesting the information, and the share price goes up. You try to bank some of those profits. And, at the moment, we're very proactively managing it. Depending on where the share price is, it might go up or it might go down in the portfolio over the next couple of months. But we remain positive on the opportunity. If you want to read more about it, we did publish a blog a few months ago that's worth a read. So as mentioned previously, quality compounders will always be a core portion of our portfolio. The trick here is buying them at the right point in time, managing position size accordingly, and not just letting them run and become overwhelming parts of the portfolio at whatever valuation. But they were big contributors for the year. You can see a couple of them on the right-hand side chart. These include TKO Group, which owns UFC and the Wrestling Federation, MTU Aero Engines, Flutter, and API Group, which has been in the portfolio for over 5 years now, all significantly outperforming the index. We've scaled them down, of course, as the share price went up and as valuations re-rated. but they continue to remain very attractive propositions and long-term stories. On this slide, we just talk about two that we've added over the past 6 to 9 months. One of them is Wise, and the other is Comfort Systems. You can see that picking them at the right point in time often is what delivers excess returns. Both of these had fallen out of favor. Comfort Systems was down 40% at the point we bought it, and it has rallied significantly since back to more historical valuations. So we have a wide bench of, companies that we have looked at that we're waiting for the right moment to, nibble away at or buy. And again, as mentioned before, very proactively managing position sizes in both of these as the valuation moves to more fair levels.
The past few years in Europe and the UK in particular have seen very depressed equity markets and continued outflows from investors. And that's allowed us to own stocks in this part of the world with significantly higher prospective returns than you should expect from businesses of the caliber that we own. Something as stable as a market-leading supermarket business, for example, in Tesco. Banks as well, they've traded at significantly too cheap prices. There's a lot of cultural change going on in that part of the world. So most of our investments in the UK and Europe now are actively buying back their own shares. This is a fairly significant change from 5 or 10 years ago. With these stocks on this chart, they're all got buybacks. They're all paying fat dividends as well. So a big change from recent past. And these investments have paid off really nicely over a couple of years now. They paid really well in 2025. And as Harvey mentioned, they paid off at the right time. They came good as the markets are melting down and people are looking for safety. These charts ignore the impact of dividends, which have also flowed into the fund from these investments. We've sold out of Tesco and Lloyd's in the past few months in favor of fresh new ideas in the UK and in Europe. ING remains in the portfolio and is a fairly large investment today. Moving on to the portfolio today, the left side of this chart shows the top 10 positions as at 30 June 2025. I don't want to get deep into each of the ideas here, but I think the crucial point that we'd like to get across is most of this portfolio is concentrated in ideas that most of you will never have heard of. This is not and will never be a portfolio with Microsoft and Nvidia at the top of the list. The fund is concentrated. About 70% of the fund is invested in the top 20 ideas, but these are diverse ideas that have been picked. They're based in different businesses operating in different geographies, and they have different market cap sizes. The right-hand side of the chart shows the various market cap buckets. The median investment in the portfolio today has a market capitalization of about US $7.7 billion. But more than a third of this fund is invested in businesses that are smaller than $5 billion.
And you'll all be familiar with this chart. On the left-hand side, it is our portfolio distribution by sector. As you can see, we're not overly concentrated in any one specific sector. It's diversified. We have some consumer discretionary, some industrials, some technology. And we do try to keep it balanced and diverse. On the right-hand side, again, same thing by geography, portion of the portfolio in the US, some Europe, UK. For those of you that follow us, you'll notice that Asia-Pac has become 16% of the portfolio. That is specifically and primarily Japan, and I'll discuss it on the next page. So Japan's a country that I've followed for quite many years and that we have followed and invested in at Forager for 6 since I've been here. There's some really interesting things happening below the surface here. The government and the Japanese Stock Exchange are really striving to improve capital returns and shareholder friendliness across companies. So you have a country where you have a lot of cross holdings, businesses that are sitting and hoarding cash, sometimes 20, 30, 40% of their market cap is sitting in cash, no debt. And what's happening over the last few years, and you're seeing a significant acceleration, is that there's been a push from companies and from the top down for more dividends, more buybacks, and disposals of some of these subsidiaries, consolidation, and rationalizing businesses and conglomerates. This provides a really fertile hunting ground for investors such as us. And the one theme that we particularly love is Japan digitization. This really took off during COVID, but for those of you that don't know, Japan is lagging significantly behind the West in terms of things that we all take for granted, whether it's cloud software, software as a service, cashless payments, and so forth. Cashless payments there are 40%. In the rest of the world, it's closer to 80. SaaS adoption is at, as a percent of IT spend is at 5% versus, the likes of the US at 20%. Ample room to run. And the government is, again, here pushing a top-down view that digital invoices, digital receipts need to happen. Companies are realizing they need to stop, papers, using rubber stamps and stamping papers and storing them on various floors of their offices. So it's happening more rapidly than people think, and we have a number of investments that touch upon the different themes in the country. But if I want to leave you with one message on the right-hand chart, is that there's a lot of exciting opportunities at the sub 10 billion market cap range. These companies are growing between 20 and 150% year on year, and not just from a low base. They're already on pretty strong margins. But their forward PE ratios are trading at a big discount to the likes of, the US software index, which grows at a much slower clip. So it's a really exciting space to be fishing in, and a space to be invested in at the moment. It continues to be a core part of our portfolio going forward.
Consumer discretionary is another area that we're quite excited about going into 2026. We lost some money on consumer discretionary stocks in 2025. Nothing too painful, but it was a source of loss for us. But it is a pocket of opportunity in this current year. The US consumer sentiment is low, but it seems to be turning. And the whole sector globally, in terms of the stock market listings, have been tarred with this real value brush. We have cheap stocks, but we've bought things that are solid brands, growing businesses, and they're growing even in this relatively difficult environment. We've bought on low multiples of depressed earnings. You never want to bet the farm on this sector. The downturns can be violent. But we've modestly increased the weighting in recent weeks, and the risk reward is solidly tilted in our favor in this sector.
And you may have seen this chart before. We have put it up a few times, but the setup for small and mid caps, we think, remains very compelling and very attractive. Small and mid caps tend to have a long-term history of outperformance versus their larger, more steady counterparts in the S&P 500, for example, in the US. They also tend to do well from periods when economic recovery starts to happen, and we have been in a bit of a malaise over the past couple of years across the board, not just in the US, but everywhere. As you can see on the right-hand chart, they are currently trading at a significant discount, 30% to the large cap S&P index. This used to be a premium, so this provides a really fertile hunting ground for active investors such as ourselves. We don't actually necessarily want this to re-rate anytime soon. We don't need it. At the moment, we're finding some really great and attractive ideas because they are trading at these discounted valuations. At some point, you might get it, in which case, being invested in this category is going to provide really nice returns. But we aren't calling when that happens, and we're not trying to profess that we know exactly when it will. And due to all of this, we think small and mid caps should be a core part of any investor's portfolio. Over to you, Steve.
Thank you, gents, and thanks to the whole Forager team for a lot of hard work and great results over the past 12 months. It's a real pleasure coming to work at the moment, and I'm looking forward to the year ahead. I just wanted to wrap things up with touching on a bit about the Forager business and our own ambitions over the next few years. I touched at the start of my presentation on how important I think capacity constraints are, given the part of the market that we want to fish in. And you can see on this slide some, I guess, hopes and dreams from the Forager end of things. We currently have about $190 million in that Forager Australian Shares Fund. We think the capacity there is 250 to 300, so not that far away in terms of that fund before we need to start thinking about constraining the size of what we're doing there. On the international fund side of things, we could replicate that portfolio that we have today very, very easily at $500 million and potentially bigger than that. So still plenty of runway on the international side of things, but capacity constraints will remain important there. You've probably seen some of my frustrations in market downturns with people trying to get their timing right about this stuff. I'll say what I have said repeatedly one more time. I think it's your job to get your portfolio allocation right. The team's made a really strong case today for why small and mid-cap stocks, and particularly the two portfolios that we are running, deserve a place in your portfolio. It's your job to get that portfolio weighting right and let us get on with generating the returns We have no idea what is around the corner in terms of markets, but we have a team, a process, and two portfolios that are very well placed to navigate whatever is thrown at us. And we've seen repeatedly over the years that if we do get some turmoil and downturn, then that's our chance to add to what we think will be very good returns anyway. With that, we will turn across to Q&A. Just give us a couple of minutes to gather your questions, and we'll be back to answer them over the next 10 or 15 minutes.